Hello, thank you for joining this webinar. This is Ali Reza Akrami, a senior power engineer with ETAP. Today, we are going to review the concept of techno-economic analysis and its implementation in ETAP 24 software. Here is the agenda of this presentation. First, we will review the basics for the concept of economic analysis, like the definition, why economic analysis matters, what scopes it includes. Next, we will review the common methodologies that are used in practice to perform economic analysis study for a system. Then we will review the cost and income types that are involved in this study. Next, we will review what would be the outcome of an economic analysis study in forms of the economic measures. Meanwhile, we will review the implementation of this study in ETAP 24 software as we move on. And we will review the implementation for a practical example file using ETAP 24. Economic analysis addresses a critical aspect of investment management in any industrial or commercial projects, including the power systems, which is the focus of this presentation. Economic analysis studies and evaluates the financial aspect of the investment to ensure the long-term effectiveness of the investment. The final objective of performing an economic analysis over a project is to evaluate the feasibility of the investment through quantifying the costs, potential incomes, and expected returns on investment. The type of project that undergoes the economic analysis study may include different subjects, such as substation expansion, investment in a new renewable power generation plant, a petroleum refinery, or an automobile manufacturing plant. This analysis will help the stakeholders to determine whether the investment is sound and sustainable over the project's life cycle or not. This will also help the user to perform a risk management and mitigate the risks that are associated with the project through quantifying the uncertainties and conducting sensitivity analysis upfront, which makes the decision-making process more robust. Economic analysis can be performed through various approaches. Two of the most well-known methodologies are covered in this presentation, which are also implemented in ETAP software. So the first method here is the net present value, or NPV method. In NPV method, for each year within the life cycle of the study, the difference between cash inflow and cash outflow of the system is reported in its present value through conversion by the discount rate. You may know that due to the inflation and deflation, the future value of a unit of currency can be lower or higher than its current value. And accordingly, converting the future value to the present value is essential to have a consistent evaluation of the study over its whole life cycle. Here, the yearly cash inflow, which is denoted by RI, corresponds to the every type of income for the project, which may include but is not limited to the revenue that is gained by selling the product of the project, which could be like electricity for a power generation plant or petroleum product for a refinery. It could be also in forms of credits or fundings or other additions. For cash outflow, which is denoted by CI in this formula, it may include any types of costs such as one-time costs, which are generally associated with the investment cost, or any recurring costs, which are charged on a yearly basis. For example, if we are looking at a power generation plant, the recurring cost can be associated with the cost for the fuel that is used for generating the power, or it can be the cost that is associated with the maintenance of the system. So for the net present value, if NPV at the end of the life cycle of the study is positive, then it means that the project is considered to be profitable. On the other hand, if NPV is obtained as a negative value, then it means that the project is not financially viable. The second approach is total life cycle cost, or TLCC method. In the second approach, the economic measure is only the total cost of the system, and it no longer includes the revenue for the system. In this case, the most favorable scenario for the project investment will be the case that comes with the minimum costs. So TLCC is generally used when the goal is to compare the cost for two types of assets or equipment, while the income that is earned by both of them is assumed to be almost similar. Also similar to NPV method, for TLCC, we also convert the costs to their present value for the sake of consistency in the evaluation. So let's take a look on how study selection works in ETAP. Currently, economic analysis is a part of reliability assessment study in ETAP. So if you open the study case editor for the reliability assessment, we have a separate page called economic analysis. As we can see, we have an analysis method group here, which includes NPV and TLCC, as well as the life cycle of the study. So we can select the desired method for the study and enter the life cycle of a study here in forms of years. In addition to that, we need to enter the discount rate and inflation rate here. So in this formula, this R is the discount rate in presence of inflation rate. In ETAP software, the total of discount rate and inflation rate will be equal to the discount rate that was represented in that formula. And this one needs to be entered in forms of percentages. We can quickly take a look at the ETAP software here as well. So if we go to power quality mode, then under reliability assessment, we can see that we have the economic analysis study. And if we go to the study case editor, we can see the mentioned values and edit boxes. So let's go back to the presentation again. So the accuracy of economic analysis study is highly tied with how accurate the costs and incomes are modeled. So as we mentioned before, the costs can be generally categorized into two types. The first one is the one-time cost, which is referred to as investment cost or capital cost. So the investment cost is the one that is assumed to occur only one time at year zero of the study. For example, for an investment on a renewable energy power plant, it will include the capital cost for every equipment installation, such as solar PVs, inverters, storages, transformers, lines, and so on. So in ETAP software, that cost will be entered as a one-time cost in forms of total installation in this edit box. The second category of cost is the recurring cost, which itself can be divided into separate types. So for the recurring costs, which are assumed to be occurring on a yearly basis, the first one that we have in ETAP is associated with the energy generation or energy purchase cost. So in an electric power system, if you are the stakeholder for the power generation plant, then the generation cost is associated with the fuel cost that is needed to generate the electric power system. On the other hand, if you are the stakeholder for a manufacturing plant, then the generation cost is actually the electricity purchase cost, and it corresponds to the cost that is needed for purchasing electricity from a power generation unit to run the electric machineries and loadings at the manufacturing plant. So in the economic analysis page, we have a separate group here, which is called energy price. And here we need to enter the energy purchase price, which could be either associated with the fuel for generating the energy or associated with the electricity price itself that is purchased from the power generator. And it is entered in forms of dollar per kilowatt hour. The second type of cost that we include in ETAP corresponds with the depreciation of the assets. So you may know that assets are subject to depreciation, which causes their value to drop as time goes. This reduction in the value of the system assets is generally modeled as an additional cost for the system, and it is referred to depreciation cost. So for the calculation of depreciation cost, there are two well-known methods in the literature again. The first one is the straight line, which assumes that the value of asset is depreciated over its life cycle through a fixed rate. This method is well suited for the assets that are worn out evenly throughout their life cycle. So for the declining balance, it is assumed that the uh, asset value for those that are subject to depreciation is entered as a known value here. Then the estimated salvage for the asset is also entered in forms of percentage. The salvage actually means that once the asset is fully depreciated, how much will be the value of the asset at the end of its life cycle. And then this rate will be applied over the difference of the fixed asset value and its estimated salvage value on a yearly basis for the declining balance. So we can again move to the ETAP software here to review what we had so far. Here we can see that we can enter the energy purchase price in forms of dollar per kilowatt hour. Then we have the depreciation, which is like a fixed rate for the straight line. And for declining balance, it has more parameters like the value of the fixed asset, the salvage rate, and the rate of depreciation. So the next type of cost that is considered in the economic analysis study is actually the power loss cost, which is associated with the cost of electric energy that is wasted in the branches of the system. So here the calculation is very similar to the energy generation cost, but it is applicable to the uh, losses of the system, while the energy generation cost only applies to the uh, generation cost that supplies the demand itself. So for clarification, suppose you are a power generation unit stakeholder, and as a power generation stakeholder, you need to pay for the portion of the power that is wasted in the branches of the system yourself. You no longer charge your customer for the portion of the power that is wasted because they only pay for whatever they meter measures, right? And this is mostly the case in most of the utilities. So the power loss cost is generally calculated similar to energy generation cost. However, that's only applicable to the losses of the system and with respect to the energy purchase price. So actually, this one is an option in the economic analysis study. If you want to exclude the power losses, you can go to the info page and then uncheck this load flow option from the info page. Then it will no longer consider the power losses of the system. We can quickly check that on the ETAP side as well. So if I go to the info page, I can see that I have a load flow option here. Upon unchecking this load flow option, the power loss costs will be no longer included in this study. So the next type of cost that is modeled in ETAP is related with the reliability incidence of the system. This cost actually accounts for the uh, uncertainties of the system that are related with the failure of the elements. So the E-cost is calculated by running the reliability analysis. And again, we can look at it from two different points of views. So as the first point of view, let's assume that you are the stakeholder for the power generation plant and you are supposed to supply the demand without any interruption. Otherwise, a penalty will be assessed based on the interruption duration, its frequency, and the tariff agreement with the customer. So if due to the reliability incidents a failure happens, then an additional cost, which is called E-cost, will be added to the cost of the system. On the other hand, if you are the stakeholder for the manufacturing plant, if a failure happens in your system, like a failure happens on one of the lines, then it will interrupt your manufacturing and reduces the benefit that you could have made. This is generally known as opportunity cost or lost revenue in the literature. So similar to the concept of E-cost for the generation, the opportunity cost is modeled as an additional cost to account for the loss of revenue that you could have earned if the failure did not happen. So to model the reliability incidents, let's go back to the ETAP again. If you are already familiar with the reliability analysis study in ETAP, you may know that for each of the elements, if you open their editor, for most of them actually, we have a reliability page. Then in the reliability page, you can enter the chance of failure or the probability of the failure for each of the elements. Then you can enter the amount of time that it takes for the element to be either repaired, replaced, or transferred to another supply. And then for those elements that are like the load points of your system, you have this interruption cost here. So you can define the load sector, and then from the sector type library here, if you go to interruption or outage cost, for each sector ID, you can define a cost function here based on the duration of interruption. So this cost function could be either the opportunity cost if you are like a manufacturer, or it could be the penalty cost or E cost if you are the power generation unit. And then based on the reliability incidence of the system, that E cost is internally calculated and used in the economic analysis study. So let's go back to the presentation again. The last type of cost that we consider in ETAP software is related with the taxes of the system. So in general, different regions of the world may have different regulations for tax implication. The assumption in ETAP is that at the end of each year, if the income is a positive value, then the tax will be applied based on the tax rate that is entered by the user in the economic analysis page of the study case editor. Something that you need to note about the different rates and prices is that you need to know that they are assumed to be fixed over the whole life cycle of the study. So, for example, here the tax rate that is entered as 15% is assumed to be the same for a whole 10 years that a study is done. Same for the other parameters of the system. So after talking about the cost, we move on to the next part to see what types of income is considered in ETAP 24. The income is generally based on the revenue that is earned from selling the products. So if you are a power generation plant, then the product that you sell is electricity, right? And then the unit for that electricity is generally dollar per kilowatt hour. However, if you're not a power generation plant anymore, but a manufacturer, then your earning will be based on the product that you sell to your customers. So this could be either like petroleum product, steel product, or any other material. However, to enter that in the ETAP software, you will need to convert it. So let's quickly review the conversion here. So let's assume that the unit price for the product is denoted by X as dollar per unit of the product. Then we need to manually calculate based on your power generation and loading that how much load is needed to manufacture 1 unit for your product. Let's say we assume that Y kilowatt hour is needed to manufacture 1 unit of the product. Then the converted value that needs to be entered in the ETAP software will be X divided by Y, whose unit is dollar per kilowatt hour. So in this way, you can expand the study to any type of uh, manufacture plant that you have, and it's not only applicable to the uh, electricity supply anymore. So after learning about the basics of the economic analysis study, the required parameters, the methodologies, and the required data for running the economic analysis in ETAP, let's look at a practical example here. So let's suppose that this is the uh, manufacturer plant that I want to study. I have already modeled the uh, electrical circuit here in the OLV using ETAP software. Then the assumption here is that for this manufacturer, the investment cost is $500 million. So we open the study case editor, create a new study case here. Let's call it EA example. Then we go to economic analysis study here, and we can see that the investment cost is $500 million. So we enter $500 million here as the total investment cost. Then it says that life cycle of a study is 30 years. So we change the life cycle of a study to 30 years, and we will be using NPV method for running the study. Then it says that asset value that is subject to depreciation is equal to 60% of the investment cost. So as I said, we need to aggregate all the assets that are subject to depreciation and take that value as the asset value for the depreciation. So 60% of the $500 million using declining balance will give us $300 million as the fixed asset, which is subject to depreciation. Then it says that depreciation rate is 2% and the salvage value is 30%. So we changed the rate for the depreciation to 2% and change this to 30%. It also says that the discount rate in absence of inflation is 5% and inflation rate is 1.5%. So as I said, this is the discount rate in absence of inflation. So we'll leave it as 5%. And then we just change the inflation rate to 1.5%. So then it says that electricity purchase price for this industrial plant is 17 cents per kilowatt hour. So we changed the purchase price to 17 cents per kilowatt hour. Also, it says that price for the manufactured product is $50 per barrel. It seems that it's like a refinery. And then electric load that is required for each barrel is 60 kilowatt hour. So based on the formula that we had here, we can divide 50 by 60, which gives us 83 cents per kilowatt hour. This is actually the conversion that we mentioned before. And then the tax rate is 15%, so it is already 15%. We are good with the parameters in the economic analysis page. We hit OK. Then for the opportunity cost, it has defined the cost function here. It's due to the loss of benefit, or even after loss of benefit, because the maximum benefit that this manufacturer can earn is like 17 cents per kilowatt hour. So in addition to that, it may be subject to additional cost if it falls above 45 minutes. So this is the cost function that is defined for the opportunity cost. I have already defined this in the sector type to save some time. So if you wish to define it as a new enter here, then you can hit new here to define a new sector, and then you go to the interruption outage cost to have it defined. So I have this opportunity cost here, which I have defined it for the loads. And then in the interruption outage cost, I have defined it based on the values that are provided here. And then for each of my load points, I have already assigned the opportunity cost that I define in the load sector, in the sector type library here to all of my load points. If some of your loads are not subject to this, let's say you have lighting loads, office loads, and those things which do not come with any opportunity cost, then you can simply change the cost for them to none if there is any by from this drop down. So far we have defined all the required parameters for the system. So we run the economic analysis study here, and we give the report a name, example EA. So now the calculation is completed. The results that are displayed on the OLV mainly correspond with the reliability values of the system, like failure rate and outage duration at each of these elements. For the EA to see the results, we need to generate a report. So what we do is that we go to the report manager here and we select the complete economic analysis report. We can see that in this report, we have the EA input data. It shows all the parameters that we have defined in the economic analysis page of the study case editor, such as the method of the study, the life cycle of the study, investment cost, and those things. So if we go to the results page, we can see that the cash flow of the system is reported from year 1 to year 30, which was the life cycle of the study. We can see the breakdown for each of the costs in this report. The power loss cost, the E cost, which was related with the reliability incident, the depreciation cost, the income, the taxes, the annual net cash flow of the system, and net present value of the system. As you can see, from year 1 to year 13, there is no taxes here because the present value of the system is like a negative value. This is the assumption that we have in ETAP. If the income is negative, then there's no tax implications. So in addition to the cash flows of the system, including the cash inflows and outflows, we can see that we have two economic measures here. One is the discounted payback period, which is also called DPP. The discounted payback period actually accounts for the total of the years that it takes for the income to be equal to the all costs of the system. Actually, it's showing the time that the net present value of the system becomes zero. So we can see that after 13.1 year, the net present value of the system becomes zero, and it starts to be profitable after that. Also, another economic measure that is very well known in the literature is the internal rate of return, or IRR. Actually, IRR shows the maximum discount rate for which, if it is applied over the total life cycle of the study, the present value will be equal to zero. So these are two of the most well-known economic measures that are used in the literature to measure the viability of the investment. So as long as this IRR is smaller than the discount rate for the project, which is the total of discount rate in absence of inflation rate and the inflation rate, then it means that the project is profitable. And as long as the DPP is, again, smaller than the life cycle of the study, then again, it means that the investment is profitable. So in addition to the economic measures, we also report the values in forms of plots. So you can see that we have the power loss cost here, we have the system income, we have the E cost of the system, we have the cash flow of the system, which is a combination of cost, income, and net cash flow. Then we report the depreciation cost, and also we report the system net present value. We can see that around this year, which is like 13th, the DPP occurs, right? Which makes the NPV to be equal to zero. So we can try running this study for TLCC one more time. Let's see how the calculation results varies. So we run the DPP, we run the TLCC this time. We generate the same report from here. We can see that analysis method is now updated to TLCC. Then discount rate and IRR, discount payback period and IRR are still the same because they are independent from the type of the study. However, here in this column, instead of the NPV value, we can see that total life cycle cost of the system is reported. So if we move to the plots of the system, we can see that TLCC starts to grow, unlike the other curve because it's like accumulated cost of the system. Another question that may be asked here is that why most of these curves or diagrams are declining. The reason is that, as we mentioned, the assets are the costs and the incomes are considered to be fixed for each year. So it means that if you have an income of $1,000 for year one, this will be the same for the next year and the next years. However, 1,000 year at the future years will have a less value in case that we have inflation. So that causes the curves to be declining. Once the costs and incomes are considered to be variable over the life cycle of the study, then the shape of this diagram will also change. I would like to also add some sneak peeks from the future version of ETAP, which is ETAP 24, and how the enhancement will affect the economic analysis study here. So the first enhancement is that now the currency signs in the project files will be synced with the currency unit that you select here. So if we change the currency to something else like euro and save it, then if we go to the power quality group and open the study case, we can see that the unit for the edit boxes is updated based on the currency unit of the project. It will be also reflected on the reports, plots, and all the display option, which means that once you have changed the currency unit to another type, the reports, all the annotation and the plots will also reflect that unit, same as we see here in the editors. The other option that we have added here is the toggle button to toggle from 1,000 currency unit to 1 million currency unit for the ease of the user. And the last one that we have implemented so far is the addition of energy purchase price to be calculated based on the source energy cost rather than using an average energy cost. So it means that once you have selected this source energy cost here, then instead of looking at an average energy cost, for the share of each of these generation units, the generation cost will be calculated based on the cost function of the generation unit. So for the power utility, if you have defined a model parameter here, then for the portion of the power that is supplied by the utility, the energy generation cost will be based on the values that are associated with this one. Same for the conventional generation units. The power generation cost will be calculated based on the fuel cost and other options that are available for the conventional generation units. And most importantly, for the renewables, including wind turbines and PVs, there will be no generation costs anymore if a portion of load is being supplied from the renewables. That will make the calculation more realistic. With that, I would like to thank you for watching this webinar. we highly encourage you to switch to our latest release version, which is ETAP 24, to use our new enhancements, including the economic analysis. Please feel free to share your feedback with us. This is just the first version of this enhancement, and we will be adding a lot of new features uh, to this study in the future. Thank you again for watching this video and have a good one.